Good afternoon, everybody. Good afternoon. I am back down on the floor live here, S&P 500 options pit at the CBOE. It is noon, and the S&P's just dipped below 6,000. That was that record just hit the other day. We're down 44 points on the day. You know what? Is it the beginning of something? Is it just some profit taking? I think it's just some profit taking. Markets got a little euphoric, right? Some animal spirits came into the markets over the last week or so, which is exactly why we had bought some put spreads yesterday. Speaking of which, those in my room in option volatility here, I will discuss this after the live stream when I get back up to the office, but possibly to hedge our IWM put spread position that we bought yesterday, we might be looking to sell a lower strike put spread expiring next week or somewhere. So just keep an eye out for that, guys. We may look to hedge some of that by selling some premium there. Let me take that off the board. As I've said, we're down 40 plus points today. I don't think it's any big deal. I'm looking up here. The VIX is up 30 bips on the day, trading just above 15. It is fairly active down here today, not as busy as it has been recently. In fact, CBOE option volume still has been incredibly high, not as busy as it was last week, but over the last few days, Monday, yesterday, Friday last week, we still saw over 50 million option contracts trade daily. And we also saw that as high as, I think, 68 million. That was either last Wednesday or Thursday after the election. So there is still a lot of business. There's a lot of liquidity, which is great. Those of you wondering why we exited ANET earlier, took a small loss on that, that's okay. Have no problem taking a small loss. As you know, our watch list, our open position watch list is really filled right now. That's because there's no lack of opportunity out there. So just kind of churning. Okay, I'm not sure what just happened there. All right, that's one of those times when traders, market makers in the pit aren't doing anything, and they all get together and watch for something. I'm not sure what that was. Hey, Bobby, how are you, man? Welcome back. Okay, how many of you currently trade covered calls, either on your own to protect a position? Maybe your investment advisor does it for you, or if you have a self-directed IRA, maybe you do it. 401k. How many of you currently trade covered calls? Okay, good. Steve, Pat, excellent. Rodney, okay. Well, we're going to go through covered calls 101 today. And sometimes maybe it's not the best strategy. Covered calls is, a really good strategy. But at times, maybe there's something better to do. So first we have to, for those that don't really know what a covered call is. Okay. Covered call is an option strategy, okay, that allows an investor, you, whoever it might be, that has a long position in whether it's a stock, in a commodity, whatever it is, let's just call it a stock, okay? It allows you to sell an upside call to collect some premium. Now, your brokerage firm, okay, looks at that as a hedged position, okay? And you don't get charged additional margin for that so long as you don't sell additional options. So let's say you own 200 shares of a stock, you can sell 2 calls, and they're going to look at that as a hedge. If you sell 3, all of a sudden you're going to get into some margin issues because they're going to look at that as unhedged. Okay. Now, why do people write cover calls? Or if I talk about writing, W-R-I-T-E, that means selling. If you write an option, okay, whether it's covered call or anything, same thing as selling. Okay. So why do people do it? Well, generate income. That's number one. Okay. You can reduce your entry point to where you bought stock or your net cost of the stock. Okay. It does give you some downside protection, not, full protection. It does give you some downside protection. It can absolutely enhance your returns. And it certainly gives you a lot of flexibility with a position, whether you're looking to just, hedge that long position, whether you're looking to continuously roll an option position. So there is a lot you can do with cover calls. Okay. Now, when is the best time? When do you guys think the best time to write or to sell a covered call is? Okay, when do you guys think that is? Is it in a really kind of muted market? Is it in a downward market? Is it in a really low volatile environment? Or when there's high volatility? What do you guys think? Because there's a lot of different angles to it. There's a lot of different strategies as to how you can do this. Okay, Gene says, high IV. Okay, sideways, limited upside in the stock, top of resistance, high vol. Good. This is really, really good. Those are really good answers because this strategy, it does limit potential upside, right? It limits it because if your stock that you own happens to rally beyond the strike of that call, okay, you can then get assigned on your short call and basically have to deliver the long stock that you own. You do get to keep the premium, okay, but you would have to then deliver the stock that you own. Okay, so let's go through some of the bullet points here. Okay, so how does it generate income? Okay, well, the premiums that you receive from the options sold, okay, you collect that, and that works great in a sideways, slightly bullish marketplace. And quite frankly, I think it works best when volatility is really high. Now, you may say, well, Scott, that contradicts what you're saying. If we're in kind of a sideways market, typically you're not going to see high volatility. And that may be true. But the more expensive the volatility, the higher the implied vol, the more premium you are going to collect. And I will go through some examples with you guys here live on how we kind of look at that and what some break evens would be. Okay. Now, we can look at it as reducing your net cost of stock. Let's just say you bought Apple at $220 and you happen to sell an option. I'm not even going to call out what strike it might be. Let's say you happen to sell a call, an upside call for $5. Okay. Basically what you've done is reduced your entry point to 215 from 220. You haven't limited your downside risk. You've just lowered that entry point. Okay. Covered calls. Okay. Enhanced returns. Sure. If you can keep doing this or rolling them out and not get called away and your stock continuously just kind of stays as is or even rallies a little bit, okay, your returns are going to be really compounded greatly. And then the flexibility you get with that, okay, so everybody always asks me, Scott, what should I look at? What strikes should I look at? What expirations should I look at? There's no right or wrong answer to that. It really all depends on your risk tolerance and your goals as to what you want to do. Okay, so let's talk about that. How do we choose our strike, right? Well, couple things. Number one, where would you be comfortable selling the stock? There's no woulda, shoulda, couldas. There's no Monday morning quarterback. If you wind up getting called away from your long stock position. So let's say you own Apple at $220. Okay. And you say, you know what? If this stock appreciates to 240 or 245, I'm willing to be called away on my stock. I would be willing to sell my stock. Okay, well, that's one way of looking at it, how you determine which strike. Another way is look at technicals, right? Where is there resistance? Where is there maybe a high volume area up above? That could be a good area as well. And then, of course, if you really want to look at the probabilities of the stock not getting called away, we can always use the expected move, because the expected move tells us with a 68% probability the size of the move out to whatever expiration you're looking at. So if you want to use the expected move as your barometer, as your benchmark, take the expected move, maybe go a strike outside of that. If you want to be a little bit more aggressive, collect more premium, then you would look at the strike below. Excuse me. This right here is what your P&L, what a graph would look like if you sell a covered call. Now remember, on the downside, selling a covered call does not completely hedge your position. It does not hedge your position. You still could have losses to the downside. You're just lowering that cost basis and thus lowering the amount you could potentially lose. Okay. And then on the upside, okay, what the goal would be in a perfect world, what the goal would be, just like how we always talk about a stock moving to the short strike, no different with a covered call. Let's say, again, you're long Apple at 220, you sell the 240 call. Where's the ideal spot for that stock to go at expiration? Right at 240. You benefit from the increase in the stock price on your long stock position. You also benefit on the decrease or the elimination of premium that you've sold that option for. Okay, so best of both worlds. Okay, now, how many of you have ever traded a protective put rather than a covered call? How many of you have you used just buying a put strategy as opposed to selling a call if you're long stock and you just want to protect a position? Okay, so what you can see on the screen here, and again, if anybody wants, yes, okay, good. If anybody wants a copy of this presentation, okay, just put a we'll put a link up here by the end of the live stream here. We'll put a link up so you can get it. Okay, so what's the difference of selling a covered call, buying a protected put? Well, again, you sell a call, okay? If you sell a call, you could keep the premium, but you're still going to have downside risk. What you're doing is lowering your risk from the entry point in your stock, less the premium you receive. On the upside, you get the benefit of the stock still rallying up to what that strike is and not being called away. Now, if you buy a protective put rather than selling a call, yes, number one, you're paying, right? You have a debit. You're buying premium, so you don't have the benefit of collecting money. But what you do get is the ultimate protection, because once the stock, if your long stock starts to go down and we go down below the strike price of that put, you are fully protected all the way down to zero. And on the upside, okay, if the stock does go up and the put never comes into play, it's like insurance, right? You buy your insurance and you hope you never have to call your insurance broker, right, to file a claim. So if you never have to file your claim with a protective put, great, you win on the increase in your stock price, and you just have lost a little bit for that insurance, for that protection that you have. Okay, before we go any further here, guys, before we go any further, what do we have today? What do you think? All right, guys, there is our word of the day for the wheel. Cover. Groucho says cover today. Okay, get that in the chat here, folks. Yesterday we had a record entries on the wheel. Make sure you get cover in the chat and make sure you are here at the end if you want to win. Okay, as we've spoken so far, we've been going 15 minutes. The market has actually rallied. S&Ps have come off of their lows of the day. They're down 34 points right now, so about 8 points off of the lows of the day. There we go. We've got cover coming in here hot and heavy. Hot and heavy. I will bring Groucho back here shortly here, folks. Okay. Now, how many of you know or have ever traded this thing? This guy right here. A poor man's covered call. And do you know what it is? Actually, this guy right here, he reminds me, for those of you that ever used to watch Price is Right, and they had the one game, the yodeler that would climb up the mountain, kind of reminds me of this guy right here. But how many of you know what a poor man's covered call is? Okay, and why do many traders use a poor man's covered call? Okay, I'm going to tell you what the big benefit of it is. Okay, let's say you want to own a stock, and let's do Apple again. Okay, again, we'll just stick with it. And let's say Apple is $220. Well, if you wanted to buy 100 shares of Apple, okay, to own that stock, what you're talking about is an investment of $22,000, okay, to own that stock outright. What if you don't have an extra 20 grand sitting around? $22,000 to own 100 shares of Apple. Okay, what could you do instead? Any ideas? Okay, there we go. A few more answers here. Okay, long call, options. Bobby, what kind of long call? What kind of long call? Well, if you own stock, okay, if you own stock, that's 100 delta. We always talk about deltas, right? Delta is how much the value of an option changes if the stock moves $1. Well, if you own the stock, it's 1 for 1. So it's 100 delta. Okay. Now, what if instead of owning 100 shares at 220, what if you bought one deep in the money call? So let's say the 200 strike call. Okay. So 200 call. So really deep in the money, not 100 delta like stock is, but 90, 95 delta call. And that option might cost you, let's say, $22. Okay. Well, now you have an investment of $2,200 rather than $22,000. Okay. Now you have $18,000, $20,000 that you have just saved. Now, is it the exact same? No, because if you own the stock, it's 1 for 1. So if the stock went up $5, you make $500. If you buy, let's say, a 90 delta call instead, and the stock goes up that same $5, okay, you're only going to make $450. Okay, exactly, Bobby, 90% leverage. Okay, but that 90% leverage for paying 10% of the cost, so many traders use this strategy instead. Okay, so many traders use this strategy instead. Sandip, it's true the stock does not expire, but what happens if you get to expiration of your long call option? Okay, what happens? Well, if it's not in the money at that time, okay, meaning it would have to be less than $200, what have you lost? You've lost your investment, $2,200. Now, let's say you owned the stock, okay, at 220, and the stock goes lower than 200, you've lost $20 at least on 100 shares of stock, or $2,000. It's basically the same amount. So if we get to expiration, like Derek just said, okay, always just exercise your call and get your long stock position. Okay, does that make sense? Does that make sense? So then what people will do is buy a deep in the money call and still sell that same option, that same whatever out of the money call it is against it. Okay, again, is it 1-to-1? No. It's close. Now, one of the other big differences, and a lot of people don't know this, don't understand this. If you own a stock that pays a dividend, okay, you only receive that dividend if you actually own the stock. So even if you own a very deep in the money call that acts like stock or is 95, 98 delta, you would not receive that dividend by owning the option. Only if you exercise that option and turn it into stock. So you do have to be aware, if you're doing this in a stock that pays a dividend and you specifically are owning a stock for the dividend, you absolutely do need to be aware of that. Okay. Any questions on the poor man's covered call? Because what I'd like to do now is kind of a rapid fire here, but what I'd like to do is take a look at a couple different scenarios, evaluate what might be an opportunity to sell a covered call. Okay, so if someone, there's Russell also, and it's funny because we're looking at IWM right here, guys, and literally right in front of me here is the Russell pit, which this is trading off of. Okay, so let's take a look at a couple opportunities here in potentially selling a covered call. Okay, there you go, Aiden. And I'll put this up one more time here, guys. Put this up one more time, and then anybody wants to give me some suggestions here on how we would evaluate strike, expiration, etc. on a certain position. Coca-Cola, Rodney. Okay, we can look at Coca-Cola, which Coca-Cola is a stock without a lot of volatility, does pay a dividend, very, very steady. We can definitely look at that. And we'll look at Apple. Okay, Groucho, you're gone for right now. Let's take a look at Coca-Cola. Okay, now remember, when selling a covered call, you can tailor it to your own risk characteristics. Okay, so what do I mean by that? What is your timing? What is your point where you would be okay if that stock gets taken away from you? Okay, so here's Coke right here, and we're trading right around $63. Okay, so first I got to decide, okay, I own it here. Maybe you own it a little bit higher because the stock has been on a downdraft here. At what point, A, am I willing to sell it if the stock rallied? And B, how much protection, to the downside do I want? Okay, so let's take a look at an option chain. Okay, and also one thing I failed to mention, I also want to look to see about earnings. Okay, if you want to take a covered call position through an earnings cycle, then yes, you're going to get paid more premium because inherently you have more risk because the volatility is higher. Okay. But again, let's take a look at Coca-Cola, $63, and let's go to January. Okay. So if we look at January options here in Coke, okay, the expected move for Coca-Cola out to January, somewhere right around $4, $4 to $4.50. Okay, so I'm going to look at that and say, okay, you know what? On the upside, 67.5 seems reasonable. Okay, maybe I'm not willing to get rid of Coca-Cola at 67.5. So then I would choose a strike higher than that. Or maybe I want to be a little bit more aggressive and say, you know, I'm willing to risk a little more of probability that the stock could get called away, but I'm going to get paid more for it so you can get more premium. Anyway, you can see because it's Coca-Cola and because options don't trade very expensively typically, that 67.5 call in January is like 40 cents. I'm going to look at that and say, do I really want to just sell that call against my long stock position and get 40 cents of premium? I mean, maybe, but my guess is probably not. Okay, so maybe you go out longer in time. Did everybody follow kind of what we did there? Look at the expected move. Look at the premium. Coke needs more fizz. Yeah, Bobby, I think I agree with you. Okay, someone wanted to look at NVIDIA and Amazon. Obviously, premiums are going to be much more expensive in NVIDIA and in Amazon. Okay, so here's NVIDIA. Stock's trading 147. Now, earnings happen to be when? Next week. Earnings are next week. Okay, so because of that, and because we're going to see volatility on the rise here, you know you're going to get more premium. But that's okay. Let's say you're long. Okay, let's say you're long NVIDIA stock. And let's look at what the expected move going to December is. Okay, we'll play it through earnings. And again, that timing is up to you, whether you want to go weekly, 2 weeks, month, 6 months, 2 years, whatever it might be. I'd be careful trading leaps. Okay, we've talked about this before. We can have another conversation on leaps. Okay, but I'd be really careful trading leaps. Okay, so with it, NVIDIA 147.5. We go out 1 month here, basically. Okay, the market's pricing in, roughly $20 move. Okay, so that would put us right up to 167 area. Okay, that 167 call, okay, out in December, that's trading $4. That's a nice amount of premium. Okay, so let's say you sold that call at $4. Okay, well, out to December, what you're doing is lowering your cost basis down to 143. Stock drops below 143 out there. Okay, it's kind of like being short a put at that point. Okay, and on the upside, you have $20 worth of room out a month where you can keep that additional $4 or $400, and your break even, if you sell the 167, would be up at 171. So now you're saying, okay, $24 higher from here, almost 20%. I'm willing to let go of the stock there. Okay. Yeah, but Rodney, if I sell the calls in Coke with the closest expiration, what do you think that premium is going to be? I'll go back to Coca-Cola here. What do you think the 64 strike call expiring next week is going to be in Coca-Cola? Everybody understand this in NVIDIA? Yeah, Derek, it's not going to be zero, but it's going to be pretty darn cheap. It's going to be pretty darn cheap. So if we look at the 64 call expiring next week, what do we got? My bad, 25, 30 cents. So, that's what it comes down to. But again, that's all based on your risk tolerance. Okay. It is all based on your risk tolerance. Okay, guys, the wheel is closed. If anybody has any follow-up questions on covered calls, or you want me to go into a detailed dive for you, just shoot me an email. Shoot me an email at the same email that we put up for the wheel contest. I am happy to have a conversation with you, happy to discuss with you what might be an appropriate strategy. Okay, so the wheel is closed. What vol pre-earnings do you take advantage of? That's a loaded question, John. That is a loaded question, because pre-earning vol for NVIDIA is going to be different than pre-earnings vol for Apple or pre-earnings vol for Coca-Cola. Again, it comes down to your risk tolerance. There is no wrong answer. I wouldn't even say it's a wrong answer. The only time that I personally would not use a covered call strategy is in an extremely low volatility environment. If we are in a low volatility environment and I want to hedge my long stock position, I'm going to be buying those puts. I'm not going to be selling calls because that insurance then is really cheap. I don't want to sell cheap insurance. I want to buy cheap insurance. Okay. I want to sell expensive premium. I don't want to buy expensive premium. Okay. All right here, guys. Ollie, I don't know. Are you in today? Did you put cover up here before? I don't know. I didn't follow it. Did you have your name up in the chat before? Mike, what do we think? Is Ollie in there? Ollie. Come on, man. Let's go. I can't really go back here, Ollie. I mean, I can search the chat just for your name, but you did not put your name up here before. But I'll tell you what, Ollie. I'll tell you what we're going to do. Sandip has won 3 times in the last week or week and a half, and it is completely random. If he happens to win again today, you'll be covered with Sandip's name on the wheel. Woo, there we go. It doesn't look like as much as yesterday. Definitely lighter than yesterday. Okay. Wow, the market really rallied. S&Ps are only down 27 right now. You're out today, Sandip? Oh, man, we got to get Ollie in there somehow. So let me look at this here. Tell you what, if Tom Chuang wins today, Ollie, that's who you will be piggybacking. Here we go, guys. Here is our wheel today. Ollie, you are tied to Tom. And I think that's a new entry today. I think that is a new entry today. I'm not sure who Michael is, but Michael, are you here? Michael, are you here? Speak up if you are. Also, if you are, you've got to send us an email to that email address right there, prosperswag@prospertrading.com. In addition, anybody that would like me to kind of analyze a covered call strategy for them in a particular stock, send me an email to that email as well. Oh, man, Michael, if you are not here, you cannot win, which means we are going to have to go back to the wheel, which means Ollie is still alive with Tom. Michael, he's here? Oh, he got in right at this. I don't see it. You got it on your end? Oh, there he is. Okay, Michael, you made it. You made it. You made it. You made it. Okay. Thanks, Rodney. All right, Michael, you see the email address I posted up here? You got to shoot me an email there with your mailing address and the size swag that you wear. Okay? All right, everybody. We dipped a little bit in attendance today. Got to get it back tomorrow. Got to get it back tomorrow, everybody. Spread the love, spread the wealth, spread the info about our live streams. All right. Thank you, everybody. Appreciate everyone. Market's still rallying even a little bit more, down only 23 on the S&Ps. VIX unchanged, and I am signing off. Have a great one, everybody.